Today I'm going to talk about taxes. The awful word, it's that time of year, but I think it's important to learn a lesson now that you can use moving ahead as you're preparing for retirement, but also a strategy that you can turn around and teach your um, kids and other family members and friends that you care about. But it's all about balancing your tax deferred retirement bucket. We've got three buckets. We've got taxable, we've got tax deferred, and we've got tax free. Today I'm going to talk about your tax deferred. So that's essentially your 401k, your IRA. These are accounts that you put money in, let's say in 2021, you get a tax deferral or tax deduction. And then when you retire, you take a portion of that money and you give it to the government who wants their tax money to run the government. So at age 72, you're required to take what's called a required minimum distribution. That's RMD. That's calculated by taking the total amount of tax deferred assets, multiplying that by 3.65, and you get a dollar amount. That is the minimum that the government requires you to take out so they can begin getting their tax money to help run and fund the government. That amount, if you're being strategic ahead of retirement, should only allow an RMD that is equal or below your standard deduction. In 2021, the standard deduction that we are able to take is $25,100. So if you're being strategic, you're allowing your tax deferred bucket to grow only to an amount that the RMD is at or below the standard deduction. There's another test. If we're trying to achieve a zero tax bracket retirement, the tax deferred bucket needs to not trigger what's called provisional income. And provisional income is any money from distributions from tax deferred accounts we were just talking about, any 1099 income, any employment income, any rental income, or interest from municipal bonds, and then also includes 50% of your Social Security. That amount in 2021 is $34,000 for a single person and $44,000 for a married couple. So if you're a married couple and you have 32,000 coming out, you pay zero provisional income. If you've got 32,000 to 44,000, they can tax up to 50% of your Social Security. And if you've got over 44,000 of provisional income, they can tax up to 85% of your Social Security benefits. Interesting statistic, couples, individuals that have their Social Security tax typically run out of money sooner, 5 to 7 years sooner, compared to singles or couples that have strategically allocated funds appropriately so they have no provisional income. So these are a few strategies that will allow you to, ahead of time, shift assets across your taxable buckets, your tax deferred buckets, and your tax free buckets so you can avoid having your Social Security benefits taxed, and so you can reach and try to achieve a zero tax bracket retirement. These strategies are outlined in the book, The Power of Zero by David McKnight.